Usually when we talk about the intersection of artificial intelligence and global warfare, we're talking about companies with valuations that just make your eyes water.
Absolutely. We're in trillion-dollar market cap territory.
We're talking about these massive hype cycles that seem to never end and stocks that, only seem to go up. It's the hottest narrative on the planet right now.
Okay.
The weaponization of code.
Right. The whole algorithms of war thesis. It's what everyone is chasing.
Exactly. So you look at a company that claims to be the nervous system for the Pentagon, a company that is literally building the AI to predict supply chain collapses for the U.S. Army and providing the Joint Chiefs of Staff with a sort of God's eye view of the battlefield. You read their marketing deck and you think, okay, this must be the next Palantir. This stock has to be trading at $50, $60, maybe even $100 a share.
It just feels like it should be the darling of the market, given that story.
But then you pull up the ticker, BBAI, BigBear.ai. And as of today, February 7, 2026, it's trading under $5 a share.
Under $5.
It's a penny stock in a sector that is minting millionaires. And that disconnect, that massive, massive gap between the sci-fi story they're selling and the penny stock reality of their chart, that is what we're obsessed with today.
It creates this huge tension, doesn't it? Is this a coiled spring? Is this Palantir back in, say, 2018 when it was misunderstood and undervalued?
Or is the market actually right?
Right. Or is the market looking past all the glossy brochures and seeing a business that is, fundamentally broken?
That is the mystery. And we are standing on the edge of a cliff here. There's a shareholder vote coming up on February 18th that could either dilute existing investors into oblivion or maybe provide the war chest they need to actually win. This isn't just a stock analysis. This is forensic audit.
And we have to be ruthless. No narrative bias. We're just looking at the math, the cold, hard numbers.
Before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it. So we have a mountain of filings here. We've got the Q3 2025 financials, the proxy statements for this upcoming special meeting, and of course the acquisition details for this big Ask Sage deal.
Yeah, a lot to unpack.
We're going to run all of this through a framework that, frankly, most retail investors just skip. We're going to look at the circle of competence, the moat, the management, and that all-important margin of safety.
And I think it's important to set the stage here. The dynamic we're really looking at is a company trying to change its own DNA. I mean, Big Bear is trying to stop being a body shop that just rents out smart people to the government.
Right.
And start being a true software giant that sells high-margin licenses. And that transition, let me tell you, is brutal. It kills companies all the time.
It's the classic crossing the chasm moment. I'll admit, I look at this phrase, decision dominance, and I get excited. It really does sound like the future.
It sounds great. And my job today is to be the wet blanket. I don't care about the cool name. I care about gross margins. I care about the share count dilution. Because cool doesn't protect your portfolio when the earnings report drops.
Part 1, chapters 1 to 3, business, management, and financials.
Yeah.
Chapter 1, business understanding. All right, let's start there. We keep hearing this phrase, decision dominance, in all their investor materials. Sounds like something straight out of a Tom Clancy novel. Yeah. But let's strip away the marketing fluff. What are they actually selling to the U.S. government?
It is a buzzword, you're right, but the concept behind it is actually legitimate military doctrine. In any conflict, the side that processes information faster wins. It's the OD, loop, observe, orient, decide, act.
So the OD loop, right.
If you can cycle through that loop faster than your enemy, you have what they call decision dominance. You're always one step ahead.
Okay, but every single defense contractor says they speed up decision-making. That's the pitch for every piece of software sold to the Pentagon. What is Big Bear doing that's supposedly so different?
Well, they are trying to automate the orient and decide parts of that loop. I mean, think about a modern battlefield. It's just chaos. You have satellite imagery coming in. You've got signals intelligence from the NSA. You have logistics manifests from the Navy. And now you have open source intelligence from, X and TikTok.
It's a fire hose of information.
It's a fire hose of noise. A human commander simply cannot process all of that in real time. Big Bear's software is designed to ingest all those disparate, messy data sets and spit out a probability. It's supposed to say, if you move Tank Battalion A to this coordinate, there is an 80% chance they run out of fuel in 4 hours. That is the product.
So it's not ChatGPT. It's not write me a poem about a tank.
No, absolutely not. And that's a critical distinction to make. Consumer AI is probabilistic and creative. It hallucinates. It makes things up.
Which can be fun if you're writing an email.
Exactly. But in the Big Bear environment, hallucination is a catastrophe. You cannot have the AI invent a supply line that doesn't exist. This is all about deterministic outputs in extremely high-stakes environments. It's frankly much harder to build than a simple chatbot.
You mentioned earlier that the company is trying to change its DNA.
Right.
Let's dig into that metamorphosis, because Big Bear wasn't born as a software company, was it? It came from somewhere else.
No, not at all. And this is where that valuation disconnect we talked about really comes from. Big Bear was formed by merging two existing companies, New Wave Solutions and PCI Strategic Management.
Okay, and what were they?
They were classic services contractors.
For the listener who doesn't track government contracting, can you break that down? Explain why services is kind of a dirty word for growth investors.
Sure. Services basically means you're selling time. You hire a really smart analyst who has top secret security clearance. You put them in a seat at the Pentagon or the NSA. Then you bill the government for their time, plus a markup.
It sounds stable.
It's a great lifestyle business. It's very stable. But it doesn't scale. If you want to double your revenue, you have to find and hire twice as many cleared people. Your margins are capped by, physics and government regulation. You can't just 10x the business overnight.
And software, on the other hand.
Software is infinite leverage. You write the code one time and you can sell it 1,000 times, 1,000,000 times. The marginal cost of selling to the next customer is basically zero.
And that's the pivot.
That's the pivot. Big Bear CEO Kevin McAleenan is trying to turn the entire ship from that services model to the SaaS software as a service model.
But that's incredibly difficult in the defense sector, isn't it? I
Yeah.
mean, the Pentagon is so used to buying people, not licenses.
That is the core friction point. The procurement officers at the DoD, they're used to cost-plus contracts. They pay for your costs plus an agreed-upon profit. They really struggle with the concept of firm, fixed-price software licenses.
So Big Bear is fighting a war on two fronts.
Exactly. They are fighting to build the technology, and at the same time, they are fighting to change how their biggest customer fundamentally buys technology. It's a monumental task.
So let's look at the three verticals they've set up to try and accomplish this. The first one, and it's the one that seems to be generating the most news lately, is global supply chain and logistics.
Right, and this is the cargo seer play. In January of this year, 2026, they acquired assets from a company called CargoSeer.
And what does that tech do?
It's computer vision technology, specifically designed for ports and borders. Think cameras and AI that can scan shipping containers and pallets for anomalies, for risks, for contraband.
I see the tie-in here with that big 80 Ports Group partnership. This seems really significant because it finally pushes them outside of the U.S. federal budget.
It is massive if it works. I mean, 80 Ports Group operates in Abu Dhabi and has a global footprint. They are taking Big Bear's tech, specifically this CargoSeer computer vision, and deploying it in commercial ports.
So it proves the tech isn't just for spies.
It proves the tech has commercial viability. It's not just for the CIA, it's for global trade. It de-risks the entire business by diversifying their customer base away from just Uncle Sam.
Okay, that makes sense. The second vertical is cyber and engineering. This feels like the legacy business we were just talking about.
It is. It is the legacy business. This is their bread and butter. It's offensive and defensive cyber operations. It's very labor intensive. It's not the sexy growth engine that gets Wall Street excited.
So why keep it? I mean, if you're trying to become a software company, why not spin off the services part?
Two really important reasons: cash flow and clearances.
Ah.
You need the cash from these, let's be honest, boring contracts to help fund the R&D for the cool AI stuff. And even more importantly, you need the facility clearances, the FCLs that these contracts maintain. You can't just fire all the services guys and expect to keep your top secret clearances easily.
So it's the anchor.
It's the anchor that keeps the boat steady while they try to build the new sails.
And that brings us to the third vertical, autonomous systems. They call this one the tip of the spear.
This is where you find the Orion platform. This is the real deal when it comes to that decision dominance concept. This is the future of the company, if it has one.
They won a sole source award for this back in March 2025. I see it here, $13.2 million, specifically for the chairman of the Joint Chiefs of Staff.
Sole source is the key word there. You have to focus on that. It means the government looked at the entire market and said, nobody else can do this, only Big Bear.
So what does Orion do?
Orion is all about force generation. It answers the fundamental question, Who is ready to fight right now? It tracks readiness levels, deployment timelines, logistics bottlenecks. It does this across the entire Joint Force, Army, Navy, Air Force. It's supposed to be the brain of the whole logistics beast.
So to summarize Chapter 1, we have a company in the middle of a painful transition from a kind of boring services contractor to a high-speed software company. And they're using these three verticals to try and bridge that gap.
But a transition like that takes capital, a lot of capital, and it takes the right leadership.
Which is the perfect lead-in. Chapter 2, management evaluation. Let's talk about the people flying the plane here. The CEO is Kevin McAleenan. He's not a tech guy, historically speaking. He's a government guy, former acting Secretary of Homeland Security.
Which is a classic double-edged sword. On one hand, he knows the customer better than anyone. He knows how to navigate the Pentagon's bureaucracy, which is a real skill.
But the other edge of that sword.
Does he know how to run a software P&L? Does he have the mindset of a high-growth tech CEO? That's the big question mark.
And that brings us directly to capital allocation. We have to talk about the Ask Sage acquisition. They dropped $250 million in cash to buy this company.
$250 million. For a company of Big Bear size, that is a bet the company move. There's no other way to describe it.
So what did they buy for $250 million?
They bought a generative AI platform that is FedRAMP ready.
Break that down. What does that mean?
Essentially, it's a secure wrapper around heavy-duty AI models, like the ones from OpenAI or Anthropic, so that government agencies can actually use them without leaking classified or sensitive information.
Okay, that sounds valuable. But let's look at that price tag again. $250 million. What is Ask Sage's revenue?
The projected annual recurring revenue, or AR, for 2025 is $25 million.
Wait a second. So they paid 10 times future revenue.
Yes. Not trailing revenue, not current revenue, forward revenue. A 10x forward sales multiple.
In this interest rate environment, with the risk-free rate over 4%, that seems...
Aggressive is a polite word for it.
It seems insane.
It is incredibly aggressive. It is a pure growth play. Management is screaming at you, we believe this asset is going to explode. They need Ask Sage to grow 50, 60, maybe 100% year over year just to justify that price tag.
So what's the outcome here?
It's binary. If Ask Sage hits $100 million in ARR by 2027, then Kevin McAleenan looks like a genius. He bought a money printer for cheap.
And if it stagnates at, say, 30 or 40 million?
Then they just incinerated $250 million of capital that they absolutely could not afford to lose. There's no middle ground with a multiple like that.
Now, usually when management makes a huge, risky bet like that, you want to see them putting their own money where their mouth is. And we have the Form 4 filings from January 2026.
We do. And this is where I get concerned. This is a big red flag for me.
I'm looking at them now. I see dispositions. I see the CEO and the CFO selling shares. Is this them dumping stock because they know the deal is bad?
No, okay, we have to be fair here. Those specific sales you're seeing are tax withholdings. When their restricted stock units, or RSUs, vested, the company automatically withheld a portion of the shares to pay the IRS. That is standard procedure.
This is not a bearish signal in itself.
It is not bearish signal, but what is a signal is the absence of the opposite.
They aren't dumping.
But they aren't buying. That is the signal.
The stock is trading at $4.72. If you, the CEO, just bought a company that you believe is going to revolutionize modern warfare, why aren't you on the open market with your own money buying up shares?
Exactly. That's the question you have to ask. Insiders own only about 2.11% of the company.
That's it? 2%.
That is dangerously low. It means their wealth, their incentive, is tied to future grants, which are basically free lottery tickets rather than their own sunk capital.
So if the stock goes to $2, they lose the value of the grant they were given, but they didn't actually lose any cash from their own savings account.
Precisely. I want to see a CEO writing a check from his personal bank account to buy shares at these prices. We are not seeing that at all.
So the alignment is weak. They are incentivized to swing for the fences with shareholder money because they have free options, not because they have their own skin in the game.
That's it. It incentivizes massive risk-taking over the preservation of capital, and that's a dangerous combination.
Chapter 3, financial health. Okay, we've looked at the narrative, which is compelling, and the management, which has some question marks. Now let's open up the hood and look at the engine itself. You call this the financial autopsy.
And it's a bloody one, I'm afraid.
Let's start at the top line. Revenue. What's the story there?
Revenue is down And not just down a little, severely. If you compare Q3 2025 to Q3 2024, they are down 20.1%.
A 20% year-over-year decline.
Yes. Now, management has an explanation for this. They say it's intentional. Their line is, "We are firing bad customers." They claim they're getting rid of these low-margin legacy services contracts.
Is that spin, or is that a legitimate strategy?
It's a completely valid strategy if, and this is a big if, it improves your margins. If I fire a customer who pays me $100 but costs me $99 to serve, that's a good business decision.
But that's not what's happening here.
No. Here's the problem. Their gross margins are compressing. They're getting worse.
Give me the numbers.
Gross margin is currently sitting at 22.4%. A year ago, it was almost 26%. It went down, not up.
22% gross margin.
Yeah.
For a company that is pitching itself as a software leader.
It's catastrophic. A mature SaaS company, think Salesforce, Adobe, even Palantir, they operate at 70, sometimes 80% gross margins.
So what does a 22% margin tell you?
It tells me they're a construction company. It tells me they're a grocery store. It tells me that despite all the talk about decision dominance and AI, the vast majority of their revenue is still coming from that low-margin, labor-intensive services work.
So for every dollar they bring into the company,
78 cents walks right out the door immediately just to pay for the work.
and that leaves only 22 cents to pay for all of R&D, for sales, for marketing, for the CEO's salary, everything.
Which is why the bottom line is red. It has to be.
But hold on, I'm looking at the Q3 report right here. It says net income, $2.5 million. It's positive. They made a profit.
That is what I call the net income mirage. You cannot be fooled by that number. It's an accounting trick.
Okay, explain the trick. How did they pull that off?
It's a non-cash accounting adjustment. Big Bear has warrants and convertible notes on its books. These are liabilities. But because the stock price has been so volatile and generally down over the long term, the accounting value of those liabilities on the balance sheet actually decreased.
And the accounting rules.
The accounting rules say you have to book that decrease in liability as a gain on the income statement.
So they made a profit on paper because their debt got cheaper on paper, not because they actually sold more software or made more money from customers.
Exactly. The line item is change in fair value of derivatives. If you strip that out and look at a real operational metric, like adjusted EBITDA, what do you see?
A loss.
A loss of $9.4 million. They are burning cash from their actual operations.
So the business model, as it stands today, right now, does not work. It consumes cash.
It is a cash incinerator. Which brings us to the balance sheet restructuring they did on January 2nd of this year.
Right. They redeemed their 6% convertible senior secured notes, about $125 million worth.
This was a pure survival move. In a high interest rate world, holding that debt was a noose tightening around their neck. By redeeming it, they cleared the balance sheet. They removed the immediate risk of bankruptcy.
But they didn't pay it off with cash they generated, did they?
No, of course not. They didn't have the cash. They forced a conversion. The debt holders had to swap their debt for equity, for stock.
Dilution.
Massive, massive dilution. They printed a whole bunch of new shares to pay off the company's credit card. It saved the company from going under, yes, but it cut the ownership pie into much smaller pieces for everyone else.
And that is the perfect setup for the second half of this deep dive. Because that dilution wasn't just a one-time event. It might actually be their ongoing business model. Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment. Okay, we are recording this on February 7, 2026. Yesterday, on February 6th, the stock just ripped. It was up 15.7% in a single trading session.
Which makes absolutely no fundamental sense based on the financials we just spent the last 20 minutes discussing.
So what is driving it? Is this just the meme stock energy coming back into the market? What's going on?
It's what we call high beta behavior. Traditional defense stocks, your Lockheeds, your RTXs, they move like glaciers. They go up 1%, down 1%. They're stable.
Right.
Big Bear moves like a crypto token. It's trading entirely on narrative momentum and probably some short covering. The market sees the headline AI plus war and just buys the ticker, completely ignoring the 22% gross margins.
Let's talk about valuation then. Because even at $4.72 a share, with a $2.1 billion market cap, is it cheap?
Let's do the price to sales, or PS math. If we are very generous and assume they hit $170 million in revenue next year, which is optimistic, they are trading at about 12.3 times sales.
12.3 times sales.
Now, you have to compare that to the gold standards in the industry. Lockheed Martin trades at roughly 1.5 to 2 times sales.
Okay.
Booz Allen Hamilton, which is the king of government consulting, the services model trades at maybe 2.5 times sales.
So just to be clear, Big Bear is trading at a premium of something like 500 to 600% over the established profitable players?
Yes. The market is pricing them like they're Palantir. Palantir trades in that 15 to 20 times sales range. But Palantir has 80% gross margins and is growing like a weed.
So what you're saying is the market is paying a Palantir price for what is currently a Booz Allen business.
That's it, exactly. That is the definition of a hope premium. You are paying today for what you hope they become in 2028 or 2030.
And that premium can just vanish overnight if they miss a single earnings call.
Instantly.
I do want to touch on one institutional move here. I'm seeing that UBS Group AG, the big Swiss bank, increased their holdings by 145% in their latest filing. Is that a vote of confidence? Is that the smart money moving in?
I would be very careful. You have to beware of the smart money narrative. UBS is a massive global bank with a very complex trading desk. Given those convertible notes we just discussed, the debt that was turning into equity, it is highly, highly likely that this position is part of a sophisticated arbitrage strategy or a hedge against some other position.
So they're not long-term believers.
I would not look at that 13F filing and say, oh, UBS loves the stock's future. I would say UBS is playing the volatility and the complex financial instruments. It's a trade, not an investment.
Like and subscribe to Stock Analytics AI. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Chapter 5. Ownership Structure. Okay, this is the chapter that matters most for anyone holding shares right now or thinking about it. We talked about the debt conversion, but there is a date circled in red on the calendar. February 18, 2026.
The special meeting of stockholders. This is what I'm calling the dilution dilemma. It's a showdown.
What exactly are they voting on?
The main proposal is to amend the company's charter to double the number of authorized shares of common stock, from 500 million to 1 billion.
A billion shares. That is a staggering number. Why does a company with a $2 billion market cap need a billion shares authorized? What's the logic?
Management's argument is that they need dry powder. They're saying, look, we want to buy more companies like Ask Sage. We want to be aggressive and compete for transformative deals. We can't do that if we don't have shares to use as currency.
So they're telling shareholders, trust us, give us this blank checkbook, and we'll use it to build value.
That's the pitch.
And what's the shareholders' perspective on that?
For many, it's pure terror. It's the dilution trap. If I own 1% of the company today and you go and double the share count to fund your operating losses or buy more speculative companies, my 1% stake suddenly becomes 0.5%.
My slice of the pie gets cut in half.
Exactly. Unless the companies you buy are incredibly profitable right out of the gate, you are systematically destroying my value.
Warren Buffett calls this the silent thief. You don't lose any of your shares, but you lose your ownership percentage of the business.
And you have to remember the context. They just cleared $125 million in debt by printing stock. Now they're coming back to the well and asking for the authority to print double the amount they just did.
It suggests their whole strategy for survival and for growth is entirely dependent on selling equity.
They are funding the operation by selling pieces of the furniture, and eventually you run out of furniture to sell.
There was a previous vote on this in December 2025, wasn't there? How did that go?
Yes, and there was significant opposition. 44.5 million shares voted against the proposals. That is not a small number of dissenters. It shows there's a real fracture in the shareholder base. The retail investors and maybe some institutions are starting to ask, when does this cash burn stop? When do you stop diluting us?
So on February 18th, if this vote passes, the floodgates open. If it fails, management is completely handcuffed.
It's a pivotal moment for their entire strategy. If it fails, they might have to go back to raising capital through expensive debt, or they just have to stop doing acquisitions altogether.
Chapter 6. Risk Assessment. Okay, we've been pretty skeptical for most of this. We've hammered the margins, the dilution, the valuation. But let's play devil's advocate for a minute. Why can't a Google or a Microsoft just come in and crush them? Why does a small company like Big Bear even have a chance?
It comes down to the moat. And in the defense industry, the moat isn't really about technology. It's about bureaucracy.
The regulatory moat.
Right. You can be the smartest AI engineer in Silicon Valley with the best algorithm in the world, but you cannot sell your code to the CIA unless you have a facility clearance, an FCL.
And that's hard to get.
It's incredibly hard. Getting a facility cleared to top secret standards takes years. It involves vetting every single owner, every janitor, every server in the building. Big Bear has these clearances inherited from those legacy companies, New Wave and PCI. They are already inside the fence.
So they have the badge access that a big tech company doesn't necessarily have, at least not for these specific classified networks.
Exactly. And then you have the FedRAMP advantage that came with the Ask Sage acquisition.
Explain FedRAMP for us. What is that?
It's the authority to operate, the ATO. The government has incredibly strict rules about data handling, especially for what's called controlled unclassified information, or CUI. You can't just type nuclear supply chain data into a public tool like ChatGPT. It would violate federal law.
So Ask Sage is a secure version.
It provides a secure, FedRAMP compliant wrapper. It allows government employees to use the power of these large language models without leaking state secrets to the outside world. And right now, that is a massive competitive advantage. It's one of the only games in town for certain agencies.
Okay, let's zoom out to the macro picture for a second. It's 2026. We have a new tariff regime in place, 25% tariffs on advanced chips and other imports. How does that hit BBAI?
It's a definite headwind for their costs. Big Bear's Cargo Sear solution uses hardware like high-res cameras and sensors. Ask Sage runs on massive clusters of GPUs. The cost of all that hardware just went up, in some cases by 75%. That really hurts those already razor-thin margins.
But is there a tailwind on the other side of that?
There is the America First tailwind. The current administration is pushing very hard for onshoring and what they call sovereign code. They do not want the U.S. military running on software that has any connection to foreign adversaries.
And that helps BBAI.
It strengthens their position immensely because they are a U.S. domiciled, fully cleared entity. The government will pay a premium to avoid foreign software, and that protects them from some international competition.
So higher costs, but a more captive customer.
Potentially, yes. But the final risk, and in my view the biggest one, is just execution.
Can they actually pull this off?
Can they actually integrate? Ask Sage. Integration is where most acquisitions go to die. Can they merge the two corporate cultures? Can they get the legacy services salespeople to cross-sell the new software products? And can they do all of that before they run out of cash?
It's a race against time.
They're attempting a classic diversification, moving from a stable business to a very risky one while burning cash. You're like trying to change the engine of a car while you're driving down the highway at 100 miles per hour. A lot can go wrong.
Chapter 7. Conclusion. All right, we've done the audit. We've looked at the good, the bad, and the very ugly. Let's land the plane. Give me the scenarios. What are the two paths forward for this company?
Okay, scenario A is the bull case. Decision dominance becomes a reality. The integration of Ask Sage is seamless, and it truly does grow 50% plus year over year. The high-margin software revenue starts to overwhelm the low-margin services revenue, and we see those gross margins climb from 22% up toward 50 or even 60%.
And the AD Ports deal takes off.
The AD Ports deal turns them into a legitimate global logistics player. In this scenario, Big Bear becomes a prime acquisition target for a Lockheed Martin or a Northrop Grumman who's behind the curve on AI. And that 12 times sales multiple gets justified because they finally grow into it.
Okay, that's the dream. Now give me the nightmare. Scenario B, the bear case.
The dilution death spiral. The February 18th vote passes, and management treats the newly authorized shares like a blank check. They just keep issuing stock to fund their operating losses. Revenue stagnates because the government procurement cycle is just too slow to fuel the growth they need.
The pivot stalls out.
The pivot stalls. The market finally wakes up and realizes this is still just a services company in a fancy software wrapper, and they re-rate the stock from 12 times sales down to 2 times sales, where it belongs. The stock collapses to under $1.
So for the listener at home with their finger on the mouse, getting ready to click buy or sell, what is the final verdict?
If you are a value investor, if you care about a margin of safety, about positive cash flow, about profits, you stay away. This is uninvestable by those metrics. The price is too high for the current quality of the earnings.
But what about for the growth investor? The person who is looking for that 10-bagger, that home run?
For them, it is a call option. You have to understand, you are not buying a stock in the traditional sense. You are buying a lottery ticket on the future of defense technology. If you truly believe in the algorithmic warfare thesis, Big Bear has the assets, the clearances, the contracts to potentially win.
But the risk is enormous.
You have to accept that you might lose 100% of your money. The extreme volatility is the price of admission for that potential upside.
It really all comes down to trust in the end, doesn't it?
It does. Trust in the management and trust in the story.
BigBear.ai is building the nervous system for a very dangerous world. The mission is critical. But with that vote on February 18th looming, you, the investor, have to ask yourself a tough question. Are you buying a piece of the future of the defense industry, or are you just paying for management's fundraising experiments? Like and subscribe to Stock Analytics AI.
And remember, this research was generated by AI based on provided sources and does not constitute financial advice. Please do your own research.
Thanks for listening to this deep dive. We'll catch you on the next one.